Index funds, mutual funds, ETFs. Which one is for you? Hi, my name is Ola. I'm sure you've heard about index funds, mutual funds, and ETFs, and you're wondering which one is for you. Which one should you invest in? So I'm going to unpack them and let you know which one you should invest in. A fund is basically a pool of different investors' money put together to invest in one type of asset or the other. The major characteristics of all funds, whether they are index funds, mutual funds, or ETFs, is that one, they are a pool of funds. They gathered various investors' money together to create that one fund. One, they are managed by an asset manager. Yeah, they specify the assets that they are going to invest in, the type of asset that you're going to invest in. There's one commonality around the assets that they invest in. And then they are generally good for anyone who is wary of the whole single stock selection process. So all of them have that commonality. They all are alike when it comes to that. Now, what is an index fund? An index fund is basically a fund that invest in an index. And what is an index? So let's say you have a store, and in that store you sell a bag, you sell a shoe, and then you sell a belt. An index is basically a tracker of the price of the shoe, the belt, and the bag. So if, for example, at the start of the day, the price of the bag was $50 and the price of the shoe was $25 and the price of the belt was $25, the index will be valued at $100. Now, fast forward to 2 days later. If the price of the bag goes up to $60 and every other thing stays the same, 25, the index will be 110. So what the index does is that it tracks all the assets in that index. It tracks certain assets, and the value of the index goes up and down as the value of those assets fluctuates, right? So an index fund typically just picks one index and tracks it. So what the index fund will do is that the index fund will buy one shoe, one bag, and one belt in this scenario, and then just wait. That's all they do. Now, a mutual fund is slightly different because the mutual fund, right, will decide that all we do is shoes, right? So the mutual fund will invest in shoes from your store and go to the next person's store and invest in shoes from the next person's store. So it will be a shoe mutual fund. So I'm basically trying to explain it in a way that you can relate. So a mutual fund will tell you what they're investing in, and then they will invest in that thing across board. They're not tracking an index, not necessarily tracking an index, right? So that's a mutual fund. So basically, what a mutual fund, in that same scenario, a mutual fund will say, we are a shoe mutual fund, and all they're going to invest in is shoes. So they will buy shoes from you, buy shoes from the next person, and buy shoes from the third person, and that's their own portfolio. Now imagine if all those shoes at the start cost $25 and they bought from 4 stores, they would have this $100 value, and then let's say 2 days down the line again, 2 of those shoes now cost $40. So the new value in 2 days' time will be $130. So you can see the logic is still the same in terms of value. However, how they invest is slightly different. Now, what happens with the mutual fund is that if you invest in that mutual fund, you buy a unit of the fund, and when you want to sell, you go back to the issuer of the fund and you liquidate, you redeem your shares, you redeem your holdings, right? Same also for the index fund. However, when it comes to an ETF, the ETF is called an exchange traded fund. Now, nature of the ETF is that when you want to sell your ETF, when you want to exit, when you need your cash, you're going to be selling to an other investor, right? As against the issuer. You're not going to be going to the issuer to redeem your holdings. And so there's an exchange for the ETFs. So the ETFs could be tracking an index like the index fund, or it could be a shoe fund like the mutual fund. However, the major thing is that in your buying and your selling of the fund, you are trading on the exchange and you are buying from one investor to another and not the issuer of the fund. Hope it is clear. If you have any questions around this, please drop it in the comment section. I'll be here to answer your questions. What are the differences, the fundamentals? So I've basically explained how they work. Now, the differences begin to come up based on the explanations I gave you. The first one is diversification. When it comes to the influence of the asset manager, for an index fund, you're basically saying, I am tracking this index, I'm tracking this store. So whatever happens in this store, if you're fine with this store and the shoe, the belt, and the bag, you are fine, right? Just buy this and you will be tracking everything inside the store. That's for the index fund. So there's less impact of the asset manager's skill. But then move on to the mutual fund, right? The mutual fund basically depends on the asset manager's stock selection skills, because I decide I want to do shoes, right? The asset manager now needs to decide which stores you're going to be buying shoes from. Which stores do I think would perform better than the other? So your asset manager skill is required. And so the ETF now is a mix. So depending on if it's tracking an index or if it is just a general fund, then the characteristics of the ETF would flow through. I hope you get that. So first of all, generally, fees are dependent on how much transactions you do on your funds, generally. However, because an index fund is tracking an index, all they do is they buy and hold, right? Their fees are usually the lowest. Then move on to the mutual fund. Their fees are next in line. And then finally, the ETFs, depending on how much trading you do on your ETF. Because they can be traded during the day, they can also accommodate you buying and selling as many times as possible, but then you still have your taxes and your fees for those transactions. But then for ETFs, they are dependent on how much you churn your holdings, right? How much buy and sell you do on your holdings. Then one major difference is the timing of your trade. So if at 10 a.m. the fund's value was $100 based on the underlying assets, and if fast forward to 3 p.m. aftermarket, 4 p.m. aftermarket, and the value of the value of the fund goes down to $75, even though you drop the instruction at 10 a.m., you are going to get value at $75. That's what they would redeem the fund to you at, the closing price. But that's the major difference with the ETF. The ETF is such that if you trade at 10 a.m., you will get your $100 value. So you can actually churn your portfolio more effectively with an ETF, because the value so you can sell at 10 a.m. and buy back at 3. That's how the ETF works. So now that you understand the subtle differences, also understanding that they are all funds and they provide diversification benefits, the final thing is, how do you know which one works for you? Now, if you want broader diversification, go for an index fund like the S&P. Go for something that broad, that covers the whole market. So if the market moves up or moves down, it goes with that. But understand that because there'll be so many assets, there'll be so many stocks or whatever in that portfolio, some will do well, astronomically well, and some will do badly, so your averages will be like somewhere in the middle. But if you're convinced about the skill of the asset manager in stock selection, so you don't want all the stocks in that portfolio. You don't want all the stocks in a particular sector. You want some specific stocks, and you think that this fund manager can do better in stock selection, then go for the mutual fund. The mutual fund is, if you have a good asset manager, the mutual fund will give you higher returns than an index fund. Because the idea is that the mutual fund and the asset manager should be skilled at picking the best stocks in the sector, right? But the index fund just gives you all the stocks in that sector, those that are good and those that are bad, right? So if you believe that the asset manager is skilled, right, and you also look at what they currently invest, their investment philosophy, their investment history, I would say go for the mutual fund. It should provide you additional return. Now, if you are someone that thinks that there's a particular sector that is going to have some volatility where you can sell quickly and buy back, things like that. So let's say you can do an ETF for mid cap or small cap stocks that generally tend to have a lot of volatility in their price movements during the day. You can actually trade an ETF. You can actually do ETFs because you can get at the price you want same day and get out at the price you want same day, right? It gives you that flexibility. But all in all, understand that they're all funds and they're good. If you have any questions about this, drop in the comment section. Please subscribe to my channel if you found this useful, and don't forget that you can't outsource your health and your finances. You have to engage. See you in the next video. Bye.